So what then soon after do banks sure that they are complete with the three in assessment they will reserve banks of governments management and yes, it all comes together. You see the functions of the three functions of the treasury department of a bank in management serve bank. Okay. For example, in my strategy two, there was three requirements, and also they are able, for example, put in place proper frameworks to ensure that their asset and liability mix and management strategy they do the able to build on their capital buffers, especially of HQS, high quality liquid assets. Yes. Another banks put in strategy to hedge at require total and also features even just by the funding sources and also their investment strategies to invest also and do proper focus. Okay, can casting cash flow and to do testing. That's the other thing. Testing to be able to test their bank's resilience to and see to be able to see if their bank are resilient to, for example, extreme market conditions and in withdrawal, being able to play proper strategies of using forward contracts and agreements, using especially able to hedge themselves against such shocks in the market. So we leave that to balance, manage strategies, then they can be put into be able that way, because not more liability. They should also, according to what is it, should stabilization, then asset liability mix. So let's example, a bank like that was very, very compliant to such interest rate and Basel III requirements. For example, during the 2008 financial crisis, was the JP Morgan case, and able to interest rate framework that, for example, quarterly they can be able to put frameworks and strategies to be able to hedge themselves against such risk. It is under regulatory requirement. Okay. Yeah. Let's just do a quick recap. So we talked about identifying and measuring interest rate risk. We talked about how we can identify such risk, especially in an hypothetical bank, so on books and risk disclosure. The gaps can be in the terms of repricing gaps, and also, for example, in the risk as sorry, identify that gap. You can be able to see how a shock in the basically you can be able to do a stress test and scenario analysis. Scenario, let's say one the interest rate, and then what do to net interest income, right? That's much. If you reduce the basically equity, and for example, the liquidity coverage ratio. So once you are able to identify that and manifest interest and even types of risk, for example, the credit risk and for example, the currency risk and forex usually used interchangeably. Now we can now see such risk, ourselves against such risk. The agreements futures, also by doing regular, also by doing regulars as a requirement by the central reserve, and also just by doing doing proper ALM, asset and liability mix management. Okay, to be able to, if we see an imbalance, that means can be and to reach the realm of an asset liability may also ensure as a capital buffer to be able to cushion us during short-term and even market extreme scenario testing and scenario analysis. The different we have the option and also casting can to even and to see this kind of bank according so about how the source options that navigation management. In this case, we looked at we looked at the hypothetical books. We say that the bank can do if they can we pay the extra like that, so that in this stage ourselves have made us want to fit, but at least we want to. We also looked at how the tool is for control. You come into an agreement with the party to predetermine a rate that rate you set up that predetermined should it below the part of your rate, hedge yourself. There is a thing that's and attack and then you are also preparing yourself for the possibility of even making at least not of not making a profit, not making a yeah. Which one is better? In this case, it will be not making a. You'd rather not make a profit. No, you'd rather not make a loss than not make a profit. I don't know if I understand. I say you loan to me the bank of money. Loan to me 100,000 Malawian kwacha at 15%. You want 15%. And then, due to interest rate fluctuations, interest rate risk, this 15 is likely to even go as high up to 17%, or even go as low as 13%. Then you are come 15%. At the 13, I have the option to pay you the right, but not the obligation to pay you at 13 or even at 15 that was if I do at 13 that I will have made a loss, right? Yeah. But if 15, I won't have made a loss by paying you at 13, would also have made a profit by paying at 7. Yeah. Exactly. So there is a kind of different in terms of making a profit. You cannot make a exactly. Okay. You attack while defending, parking the bus. Exactly. Those are not right. Likely, but if there is possibility of making a profit, right? I mean, people, that's the essence of business, taking risk. I mean, there are a whole lot of motivational quotes about that. Business banking, you'd rather not make a loss, especially in terms of mitigation and especially interest rate risk. Make a loss by still paying at 13 because that's a chance just cannot afford. Yeah. But then the Treasury Department, before entering into this futures or forward agreement, will have now predetermined that if we set the predetermined rate at this, then at least we will allow even and then we were able to each individual line item of the balance sheet of the hypothetical bank, how in the gaps we can be able to identify each, for example, each item that are risk sensitive, both in the short term and the long term, can be able to be exposed to the different types of interest rate risks, and then, for example, the rating gaps. For example, we talked about the short loans and deposit. Let's say there are three within three rate sensitive short-term deposits and loans respectively. So that risk pricing gift and how to hedge against that. And also even in the long term, for example, corporate bonds and also long-term borrowings, especially if you borrow from other financial institutions, IMF, things like that, and also even bank, though in the bank is usually a short-term lending option. Then we developing strategies for interest rate and we talked about that, right? Yeah. So, and then so now we came to the central bank's role. No, that was scenario analysis and stress testing. We talked about scenario analysis and stress testing, okay? Where we do the identification and putting in place the mitigation frameworks and strategy put in place basically frameworks to ensure that going forward, to forecast, to simulate extreme market scenario, either a market crash or, for example, a surge in withdrawals. And if our banks, for which the treasury is able to be resilient enough to withstand such shocks. Okay. From there, should we that won't be enough, then we can put in place measures before such a shock happens. The deposit, and then we regulatory requirement of basically interest rate monitoring and also mitigation to ALM, asset management. We saw of any bank all interrelate and correlate. Okay, see how risk management, for example, in this case, interest rate risk management, all traces back to ALM, that is asset liability management. Okay, for example, we saw they are to continually from time monitor, put in place risk, interest rate management, and also mitigation. Okay, through the interface to monitor interest rates in their banking book, what we call interest rate risk in the banking book, IRR, IBB.
IRB, is it?
It's called actually IBB. They are required such disclosures, and also they are also required to maintain capital requirements. For example, if they see that they will be properly not held towards dealing or being resilient toward such interest rate risk, then they should be able to put in place measures to ensure that they have enough capital buffers in terms of HQLA, that is high quality